Hello, everybody. So I'm Richie, and we have Sir Perko, aka Perko, right over here. Last time we recorded this last time. We got a bunch of questions that actually got sent into us, and we're honestly just gonna go through the questions and what your questions are. So if you have other questions, send them on in. But also look out. Next time we're actually gonna do this live.
Yeah.
So you can actually talk to us live.
More interactive.
More interactive, and just send us all your questions then, and that'll be fun. So look out for that. So let's just get right to the first question and see where we go.
Yeah, so this one's from Dan, subscriber from Nevada. He said, I have $90,000 in student loans, a car payment, and credit card debt. Where should I be investing to get the most return? I would assume in order to, make some money to help pay off his loans is what he's talking about.
Yeah, I would assume so. Well, at first I had 90,000 in student loans that's probably what most people actually are graduating college with.
It's expensive.
But I have to assume it is a lot.
Yeah.
I would probably honestly say is the first thing is to start, literally put all your loans, the interest rate on every single one, and put them all next to each other, and tackle the biggest one first, and then go down,
right?
Almost, because I just think of loans is it almost destroys your ability to even start investing, right?
Yeah.
Because basically think about it like this: if you have credit card debt, is at maybe 31%, okay? Student loan debt is most likely at about 9% if it's the public, and then the other half is probably public debt. So that's probably the public debt maybe at 4%, and then a car payment. I don't know what car payment would be at. Let's just say it's 7%. Okay, so credit card debt's at 31%. Next highest is your private student loans at 9%. Then you have your car payment at 7%, and then you have your public student loans at 4%. Okay. In order to make an investment worthwhile, right? And you have a 31% interest rate on your debt.
Yeah.
You have to be making more than 31% in the stock market in order to make that worth it.
Right. Right. Which is
that's a serious
ridiculous.
Return. That's a really hard return to find in the stock market. I'm saying you can't find it.
It's also hard to repeat.
Very hard to repeat. Instead, why not just pay off that 31%?
Right.
And now all of a sudden, I know it's the math does not work out this way exactly, but I almost think of every time I make a payment on a principal of debt, and then whatever the interest rate is, I feel like I made that with whatever the principal is that I tackled. Right? If you're wondering, basically the way debt works, it's part interest and then it's part principal on it. And so the 31, basically anything you pay over the base minimum in terms of interest, you're going towards the principal, which lowers the total amount of debt that you have in something.
Yeah.
So anything
it'll lower your
future payments.
Yeah, it'll lower your future payments. Yeah.
Exactly. And so anything over that I'm tackling with principal, I just think of I made that money. So I almost think if I paid $1,000 and that loan was at 31%, I made $31 just by making that payment.
Yeah.
Instantly. That's kind of how I think of it. And so I would literally just go down the list for wherever this guy is and just tackle the largest ones first. First tackle
largest interest payments.
Tackle the large credit card debt.
Credit card's
first.
always going to be probably the top.
Yeah.
Get that. It's outrageous.
It's outrageous, right? And so you get that off the books.
Yeah.
Then you go to your student loan. Get that off the books. 9% is still pretty high.
Yeah.
Car payment of 7%. Did you look up what the average car payment is?
Yeah, you were on. It was around 7.
Oh, really?
7.5.
Wow, that's pretty good.
The average.
Okay, so 7.5. Yeah. I don't know. I might have a more out there viewpoint on cars.
Which is?
Well, I just I view it as a depreciating asset, right?
Yeah.
So you got a loan and you got something that's losing value.
Yeah.
And you're paying for it.
Right.
Based on the loan. So you're losing the 7.5% and you're losing the value of the car. In the car. So basically you're getting hit twice.
Yeah.
And so I almost I never think of getting a loan on a depreciating asset. Essentially, because like I'll take a loan on something that's appreciating, like a house.
Yeah, of course.
Right, because your house
value goes up over time.
Right, instead of going down. Hopefully, it doesn't go down.
Hopefully not.
Make a good investment there, right? So, I'd almost say like you should almost never have a card payment. Would really be my advice. Like, if like there are plenty
try to just buy it.
Just buy it with cash.
Just buy it cash. I mean, if you can, obviously. Like some people can and they really need a car, but you know.
If he's talking about like where should I be investing, so he must have some cash lying around.
True, right.
Right.
And he's trying to like, I guess, grow in order to
exactly. So he must have some cash lying around, and so I mean, honestly, like it might suck that you're no longer driving the nicest car in the block, but like also like. You're in some very that debt.
Yeah.
Right. So you shouldn't be driving that nice car. You should be just get a car that's worth like $6,000 that literally just runs, just wheels, gets you to where you're going. Buy it in cash, and all of a sudden, you're
saving more in the future.
Like you're saving more in the future. Basically, you got to fix your situation right now to save in the future.
Because it's just bleeding. All these interest payments are just bleeding you.
Of
money.
Yeah, right? Like
for no reason. I mean,
like think about it. Maybe you're right now with all these interest payments, you're able to put $100 a month into an account.
Right.
But imagine all of a sudden you don't.
Losing.
Yeah, you're losing, right? Imagine
unless you beat that return, which you're not.
Which you're not going to beat 31%. No. But imagine you pay off all of these.
Yeah.
Right. So you take out the 31%. You get it's going to take you a while to get through the 9% student loans because that's almost $45K.
Yeah.
Like that's a lot.
It's a lot.
But you also knock out the car payment right away.
Yeah.
All of a sudden, what if in in like every month instead of saving $100, all of a sudden you're now saving $2,000.
Right. Just because you don't have to pay those super high fees.
And now you're actually able to compound your wealth because you're putting in so much more every single month. So basically you got to better yourself now to better yourself in the future because all this would be a problem. And then the 4% in public student loans is that's something more manageable of that you can out invest, right? Like, or the risk-free rate on a lot of brokerage accounts, for cash, you can get like about 5 to 5.5%. So I almost think of that as like, as long as that stays above the 4%, you can just park it in like a risk-free and it's basically paying off.
It's like SPACs and
then you make like the difference of the 1%.
Yeah.
So not really worried about the 4%, but the credit card,
but it's manageable.
It's manageable
because you can get 5% risk-free and.
Yeah, and stock market, just think of the stock market on average returns 10%. So basically anything around 10% is not a good spot.
And I guess, if you had to conclude, the big takeaway is just get rid of the debt as fast as you can. Probably worry about that more so than putting as much as you can in the market to try to make money to then like level yourself off with the debt. I mean, you just want to get rid of it so it's not eating away at you for a longer amount of time because that's when it really starts to become dangerous.
Exactly.
You're just basically losing all this money the more you put it off. You just want to make the payments as big and as frequent as possible.
Exactly.
For what you can handle. Because once you're out from under that,
then all of a sudden you have
way more to put in, and that makes
options
a way bigger
open
difference.
up. Your options open up. Everything opens up. You're way more flexible, feasible to do whatever you really want. So I'd say that's the big one, and the last one I would say is don't get a loan on depreciating asset. But so
I guess that that could go into our next question.
What's this subscriber's name?
This is Mark.
Mark
from Indiana.
Wow.
Interesting.
A couple Midwest people.
Yeah.
We love the Midwest.
Well, is Nevada Midwest?
Actually, that's a really good question. No, it's not.
No,
move on from that one.
This is why you're not a geography guy.
I'm definitely not a geography
math guy. So anyways, say you get out from under all this debt and you suddenly have a lot more to save.
Okay.
How important is conviction in long-term investing? A lot of people seem to fall in love with the story around a stock, especially when holding them for several years. So you would, say this guy like were to pick like some stocks that he just like loves the company or whatever, how important is this conviction in long-term investing, and what are maybe some other things that you'd rather have people think about when shooting for long-term?
For long term, like, I mean, there's a time and place for a good story. Like, there's always some company that's going to be curing cancer, and most 99% of them are not going to be curing cancer. But if you somehow find the one, like, I guess,
Yeah.
but the chances you find the one are pretty low.
Yeah. This sounds a lot like biopharma investing.
Well, it could be like anything. People fall in love with like a lot of stories, right?
Yeah.
So
It's
I
like
would
Fire Festival. You believe the story, go to Fire Festival. There's no food. There's no water. Remember that? Did you watch that documentary?
No, I didn't watch that
Oh,
documentary.
it's
Kinda
crazy.
heard about
You'll
it.
have to watch it.
I do like good festival. I would say more though, like think about just like companies like in your personal life that you're using that are going to be around for a very long time. Like they are ingrained in our society. That's more where I would lean for something like that. Like if you're looking at like a really long-term investment where you're just trying to like just save, right? And just put some money to use.
Yeah, you think it'll grow incrementally over long term.
Something that's not going to go away. Like there's no chances. Now, if you want to put, I don't know, a small percentage into some hope and dream, I mean, go knock yourself out.
Right.
But
don't expect anything.
Don't, just know what you're doing there, right? Like Walmart. I mean, is Walmart going to go bankrupt tomorrow?
Most likely not. Most likely not.
Right. And
Apple, I doubt they'll go bankrupt tomorrow.
Yeah, like where everybody's hooked on iPhones, right? Like whether you want Apple or Google, like, okay, like people can have that debate out there. But if you're just like, that's a great one. What's another? Like, I mean, Verizon goes into all these. AT&T goes into all these, right? Like, you need the cell plan as part of it.
Yeah.
Like there's just insurance companies, right? Like,
they're gonna be around,
right? Like we all like have a job. Well, not everybody has a job where you get medical insurance, but those insurance companies make money every single quarter or whatever. Because like if you're paying them and they're a part of your life and you need them, everybody's doing that. Money. They're making money somewhere, right? So that's more how I would think about it than like falling in love with like the next thing that's going to cure cancer almost. Like but also understand, like have a portion of your portfolio, maybe some stuff that you like believe is going to be around the world a long time.
Some less mainstream type of things that you're like, I think this is really going to make it big. And like, you're going to get some crazy return over a long term because this company is really going to come out, change the world. Sure. Like,
Yeah, but
do that.
Like understand.
Not all of it.
Maybe not do your whole worth in that. Maybe just like have a little subset of like, I really believe in this. And then majority of it is in stuff that like isn't a hope and a dream.
Right. And then that moves into like diversification in a portfolio. Don't put all your eggs in one basket. You want to avoid drawdowns and losses.
Yeah.
So you don't want to just make all these bets on smaller things that you maybe believe in the company for some reason to grow a huge amount.
Exactly.
You want to be a little more safe.
Yeah. Think about it. Like, let's go back to our first guy here, right? 90,000. Like he has 90,000 in student loan debt and this credit card debt. He's now probably going to have to work maybe the next 2 years to pay it off. Right?
Yeah.
And working is not like 9 to 5. You're working your 9 to 5. All your money's going towards bettering yourself in the future. Mm-hmm. Now, all of a sudden, you get there in 2 years. Do you want to, now that you're able to invest, be losing?
Yeah.
Losing that money that you just worked so hard to get to in that point? The answer is no.
Yeah.
Like,
because it can happen very easily.
It can happen very easily, right? Yeah. And that's the biggest deterrent to like a lot of things. Is basically what happens is like a drawdown destroys your wealth.
Yeah.
Because when something goes down, let's say it goes down 20%, like you literally own 20% less. Like
the stock needs to be up more than that for you to break even.
Yeah.
I'm not sure what the exact math is on all these, but that kind of blew my mind when I first heard those statistics because you just own less share of the company when it draws down.
We can do the math here.
Okay, let's go.
Where We're going to do some math on these computers. They do work.
This is one of the ones he hasn't blown up yet, so let's hope this doesn't do it. Ricci's known for blowing up computers.
Yeah. So if you lost 20%, wait, let's
like the stock were to go down 20%.
Wait, let's just we can do this for a lot of things. All right, this times this.
A lot's going on over here.
This. Okay. So if stock goes down 20%, in order to go back to break even, so let's say you had $100, you lost 20%, now you only have $80. In order to get back to the $100, you need to be up, it's 25%. So
who knew that? I mean, I did not know that. You know?
Yeah, give me another number.
It's great. Say with MPW, our most famous short, I went down, 85%?
Okay, so 85%. If you lost 85% in something, you now have to be... So if you lost 85%, you had $100.
Yeah.
85%, it's now worth $15.
Yeah.
Okay, in order to get back to the $100, you have to be up 567%.
That's crazy.
That's
reality.
That's the reality.
People don't realize that.
But also that's just the percentage, right?
Yeah.
Think about the time.
Yeah.
It takes. So now
go up 500%. Unless you're NVIDIA, it takes forever usually. Or a biopharma company that.
Well, I would more think about like that. Yeah, you're right. Or it never comes back, right? Which is the more likely scenario in that case.
Yeah.
But let's say you're just down 20%, right?
Yeah.
So you just have the $80. Now you have to go up 25%. Okay, so if the market returns 10% a year, you're looking at 2 more years in order to get back to where you were yesterday.
Right. Which could have happened in a day too. The drawdowns can happen pretty quick.
A day, a week, or whatever. But the reality is your 2 years is a lot of time.
Mm-hmm. Oh yeah.
Right. So that's why it means so much to not have those drawdowns in your wealth, because you're losing time, you're losing money. It's really not good. Where the reality is, if you can avoid that and actually be investing during that drawdown instead of having no cash, because during that drawdown, you're going to have a lot of opportunities are going to come up that weren't there before. And if you are able to take advantage of that, now you're starting from just a way better spot than another spot.
Yeah.
I don't remember what the question was.
Well, that led right into the next question, which is, how do I know if I should be worried about a significant drawdown, or should I always be worried about a significant drawdown? And I think you kind of nailed it, where you always want to kind of have that in the back of your mind. It's all about risk management, not necessarily hitting a jackpot, right?
Yeah, risk management, don't hit a jackpot. Should you always be worried about a drawdown? The answer is no. The thing is, there's different, it would be macro is kind of the answer to that, which is what I do actually for a living.
What you do.
We do have a job here.
Your job. You have jobs. It's hard to believe.
It's hard to believe they did hire us. It was a long road. We finally made it. No, but anyway, is that I would almost say there's different regimes, and it's really kind of something that we tried to basically tell people is what regime you're in.
Yeah, we model it out for all our subscribers.
Right, and to tell you what regime you are in, and that'll tell you if you can be risk on, risk off. And so I just say there's different regimes where a drawdown is a lot more likely, and that's where you want to be a lot more cautious. Versus there's other regimes where it's a lot less likely, and where you can be a little bit less cautious, be a little bit more risk on. So I wouldn't say you should always be worried about a drawdown, but you should always be aware of that possibility, and not that's why you don't put all your eggs in one basket.
Yeah, be aware of the underlying data and how you should be thinking about the market, and I think that also kind of leads into this other question that we have here, which is sort of about current events, not as evergreen, but so I saw that the Fed cut rates. Does this mean we are in a recession? Should I be worried? I have an investment account where I mostly have tech. NVIDIA hasn't been working for me lately. Is that likely to continue? So that's a loaded question, but
So we have Fed cut.
We sort of covered this in our other series, Rooster Reacts, where we unpacked the Fed meeting for subscribers and talked about how Powell is kind of a shill for Wall. I mean, not a shill. He's just kind of a puppet for Wall Street.
Yeah.
And how to look at these Fed rate cuts that just happened, historic.
Yeah.
So yeah, I'll let you take it from here. But
Okay, so Fed cut, yes. Like when a Fed cuts, like okay, what
the Federal Reserve.
when the Federal Reserve cuts rates, like you saw, so they cut it by 50 basis points, which is pretty big. Okay,
Pretty significant.
pretty significant. Like what they should be doing, that should mean yes that you're in a recession. That doesn't, although that doesn't mean that we're in a recession, because
No.
the Fed doesn't always do what they should be doing. If that makes
Yes.
sense, there's a lot more that goes into this, and a lot of times the Fed doesn't even know what they're doing. So
That's another problem entirely.
we'll cover that. In a
That's
later.
covered in our other series if you want to go check
And
that
so
out.
basically, so yeah, they cut. So no, that doesn't mean we're in a recession. We model. This is also part of our job. We model if we're in a recession. I can tell you, simple answer: we're not in a recession right now. It doesn't look like we're entering one. It does look like our economy's slowing, but that doesn't mean we're in a recession. So what that means is the Fed cut. Should you be worried? My answer would be pretty much no. You should not be worried. More because what's happening is that with this Fed cut, we're seeing asset prices, so prices of everything, going up.
Yeah.
So that would
Inflation.
that means inflationary. And one of the best ways to like protect yourself from an inflationary thing is to be invested.
Yes, exactly. Or else you're losing.
Otherwise, you're losing, right? Because like, let's say a house goes up by 20% in the next couple of years. You're not invested, that means you lost the 20%.
Essentially, yes.
But let's say you're invested and you covered the 20%, like your account goes up 20% and the houses go up by 20%. Well, now,
then you're good.
yeah, it kind of sucks that the housing prices went up 20%, but
Yeah.
at least you're not like flat to
Down.
negative
Right.
versus the housing market.
Right.
And so the best way to protect yourself is to own assets. Now, what we would say in this type of environment is more that like there's different asset classes that'll do better. A lot of it is like a hard asset type of situation.
Gold's doing well right
Gold's
now.
doing well.
Dollar's being currently devalued.
Yeah,
I mean, down 5%.
yeah. So people want to be buying the dollar, but like but most people are like wouldn't be investing in like in holding the dollar.
No, it's a good point.
The dollar impacts other things, but yeah, I think moral would more just be you own assets and like
to keep up with the rising prices.
exactly, and like some of those assets can be stocks.
Yeah.
If you can't afford a house right now, then you're probably owning a stock.
Yeah.
Like that is also an asset that will go up during this time.
Yeah.
And so I would almost say like your biggest deterrent during this time is actually not being invested. So having cash is actually one of the biggest issues right now. Because cash is not going to go anywhere. Everything else is going up.
Yeah.
Maybe I could go like this.
Yeah.
But right,
I see what
everything
you
else,
mean.
yeah, everything else is going up. So you want to have things that are just going up.
You want to keep up.
You just want to keep up.
Yeah.
That's literally all it is.
Yeah.
And honestly, that's really all investing should be for people is that like
Right.
it's not about becoming a millionaire overnight or anything. It's literally just about keeping up with
Rising inflation.
rising inflation. Because really what it all comes down to is the people, the billionaires, the millionaires, all these other people, what do they own? They own assets.
Yes.
Okay? And
Plenty
of assets, many more assets than you have currently, right? That's why they're a billionaire or millionaire, and we are not.
No.
Right?
Yet.
Right? So when this happens, the housing prices go up. Well, guess what? They own 10 houses.
Right. So they're making more.
So they're making more.
While you, uninvested, are losing purchasing power, they're making tenfold.
They're making almost tenfold of what you have, right? So it's always going to be beneficial to those people that have the most. But right, so just think about But then when they sell, now they have cash, right? So basically all that happens in an inflationary environment is the amount of money in the system goes up.
Yeah.
And it's called M2. And you just want to keep up with M2 just to keep yourself level
in the
to
game.
Everybody else.
Yeah.
And those everybody else, the people who have the most money, the people who have the most money are millionaires, billionaires, all those people.
Right.
So just to keep up with them, you have to have assets.
Yeah.
AKA be invested. And in this environment, it should be quite inflationary.
Yeah.
And so you should see like things go back up. And then what happens is the upper class is basically getting richer, the lower class is getting poorer, and we're in that whole story again.
Yeah. So that's in our other video. I recommend people check that out if they're interested.
Yeah, it was this last week, I think.
Last week.
We call it something reacts. It was last week on the Fed.
Rooster Reacts.
Yeah. There we go.
And I guess that'll kind of lead me to just one other question I thought was interesting. Can someone with no college background in finance break into the industry and become a sophisticated investor on their own? Like someone say, we were both financial related majors in college and knew we kind of wanted to be in this field and were interested in it. But someone who, is in an unrelated major or just like other completely different path, like you need to be invested. Everybody needs to be invested, like you just said, to keep up with this influx of cash into the system, to not lose out to inflation. How easy is it for them to break in and try to understand this stuff and have it benefit them?
Okay.
Because it is complicated.
Yeah. I would say, okay, how easy would it be to get a job in this area? I would say very difficult because all these people are like, oh, you didn't have this degree, blah, 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 therefore you're not.
It's very credential based.
Yeah, it's
like hiring. It's
crazy
in and around finance.
I had that problem, but anyway,
so did I.
Yeah.
And I literally majored in econ. I was like, what do you want?
What do you want from me?
Yeah.
So that part I would say hard, but the other part, the better part, the silver lining, if not even better, is that you don't need to be a finance major to understand any of this.
No.
The thing that they're not telling you is that this is kind of pretty simple when you get down to the bare bones of what's really going on.
You break down the jargon, that's a huge hurdle for people to get over, is what all these words mean. Yeah. Which I get. But once you just become familiar with it,
you can pick it up very easily. Very easily. It also depends on how deep you want to go. But yeah, there are so many tools to teach you.
Yeah, Hedgeye University.
Yeah, we have something called Hedgeye University, which would help.
I mean, honestly, Investopedia is great. They have the definition to anything you could think of, which I use sometimes.
For college.
Exactly. ChatGPT also, is great.
Yeah.
Like if you're just looking up, what does this mean?
Yeah.
Asking it to analyze something and summarize videos, articles. I do that occasionally. There's a million ways to get in, but it's more important that you just know that you're not left on the outside. You can understand this and use it
very easily. I would actually recommend anybody who's talking in a way that it's just a simple thing. Yeah. It's really simple what we do, right? Like there's stuff where the price of it goes up and you want to be in the thing that goes up. You just want to own the thing that goes up. You want to own the thing that goes up. How does something go up? There's more people buying it than selling it. Mm-hmm. That's literally all this game is.
It's less than Econ 101. It's like middle school econ.
Literally.
That. And then it just gets complicated from there because people try to nitpick and
create all of these stuff. Yeah, exactly. They're trying to get an edge on that supply, or people going to buy or sell. Right. And that's where all of the complicated stuff gets to. But you just keep it simple, right? Go back to my example. How many do you walk into a Walmart? How many people are there? A lot. Is the amount of people going into a Walmart going to go up or down?
Up? Down? I don't know.
Well, that would be the question, and then the person know the answer. I would personally probably say up because if you're going to go into inflation, price of things are going to go up. People are going to look for stuff that's at a discount, cheaper alternative. Walmart's a cheaper cheaper alternative.
Dollar stores, things like that. Yeah, I mean, that's just for right now. That's not
Yeah,
evergreen.
I mean,
but
this is just, it's not really advice. It's more just like understanding the simplicity of this. Like Amazon, a great one. When you go and ask a 20-year-old and they're going shopping, where are they going shopping? Are they going?
like they're shopping online on Amazon.
Yeah,
Usually almost all the time. Where if you need something, you order it's there the next day.
Yeah.
Yeah.
Right. And versus if something takes 30 days to get, are you going to be shopping there as much? Probably not. So more people are probably going to be buying something like the Amazon.
Right.
Right. So like just break it down into this like the bare bones simplicity, and like you can understand pretty, like I'm not that smart, and you can
It's like the great companies are expensive for a reason and they go up for a reason. The market goes up 10% a year, which all that means to you is that you should buy that because it'll literally just make you money on average.
Yeah. And then watch out for like a drawdown.
Watch out for drawdown. Just stay educated.
Stay educated. Watch some of the like
literally
the
just like the news. The news. What people are saying. You don't have to believe all of it. Like I know we don't.
Well, yeah, I would not believe most of it. I would believe our news. Basically, the only reason I say that is because like there's independent news, and then this is for everything in life.
Yes.
There's independent news, and then there's news that's not independent. The way the non-independent ones work is essentially they get paid by advertisement. So the people who have ads pay them.
Which we do not have.
We don't have that.
No ads.
I don't think we've had a single ad this whole time.
Nope.
Anyway, bringing it to you for free on the goodness of our hearts.
Yeah.
No, okay, wait, I got distracted here. So the ads, right? So they have ads, right? Now, let's say you're a company, you get 20 million in ads from one company every single year. That's a nice pile of cash. I like some 20 million.
Right.
Now, what happens is your boss man, he understands that. Mm-hmm. And he's like, okay, these people are paying us 20 million. What if we can get them to pay us 40 million? Okay, how do you get them to pay them 40 million?
You make them happy.
You make them happy. You promote them. So what do? You literally, you create content.
You give them more money so they can give you more money.
Yeah, you're literally like creating content, whether it's true or not. It's content that they would approve of.
Right.
And that's all you keep pushing. And then you don't push the content or have content that counters them.
Yeah.
Because this person is paying me 20 million. This other one that counters them would lose me my 20 million. Therefore, I'm going to keep pushing this thing that gives me $20 million. And that's essentially why I would say, like, I trust the independent guys way more because there is no conflict of interest.
Exactly.
And you're getting what somebody actually believes is true, whether they're right or wrong. At least they're just trying to be right. They're not trying to push something that somebody else is trying to push. And it happens all the time in financial news too. It's essentially they have sponsors, and then they're trying to push whatever the sponsor.
Trying to sell stock. CEOs go on these networks all the time and try to sell their stock because guess what? That makes them more money.
Yeah.
Which in turn makes the network more money.
Exactly.
So that's that whole game.
Right. So like for everybody, right, a CEO, part of their paycheck or bonus is whether or not the stock price goes up.
Yeah.
So if the stock price.
They also get stock.
So
they want it to go up so then they can insider sell it. That's a whole separate thing, but yeah.
No, we can go on that. I mean, so like they're paid in stock. Let's keep it at that. They're paid in stock.
Their money is greatly tied to the share price.
Exactly. Right. So if the share price goes up, then they make more money. Yeah. How do you get a share price up? More people are buying than selling.
Yeah.
So how do you make more people buy? You go on and advertise. You go on all these shows and you advertise yourself. And then that creates interest in your thing.
Yeah.
And more people are likely to buy it. And the more people are likely to buy it, more the price goes up.
Yeah, it increases the value of the company. It gives the company more money to do whatever they want to do. Like it's basically, people are spending more to be a part of this company. So the company gets more money, the CEO gets more money, the networks get more money, everybody gets more money. The investors, their money goes up. But they'll do this and then they'll miss earnings, right? And then all those people that he sold the stock to will end up losing. And so it's just you don't necessarily want to believe what basically the company salesman is telling you.
Right, because they're just trying to sell you stock. They're not trying to actually sell you and tell you what the actually is going on in the business. Like a business, like just look at like FTX as a prime example, right? They went bankrupt because what happened was they were just, I believe it was proven that they were laundering money, or just like money would go
10
in.
billion or something.
Yeah, like money would go in to this exchange and then it would just disappear, essentially. I'm pretty sure that's what happened, right? But you saw FTX, their CEO, Sam Bankman-Fried,
on every show.
On every single show.
All over the place. Celebrity.
Until the day it went bankrupt.
Yeah.
Literally.
And no one could get their money out.
And then nobody could get their money out. So they're not going to tell you like, oh yeah, our company's fine. No, they're just literally trying to get you to use their things.
Yeah.
So that they get more money.
Yeah.
At the end of the day. So like, it's literally like you can't trust them. Like they are like, you almost have, like when you hear somebody talking, you almost have to say like, you're lying to me.
Yeah.
Like you cannot look at like.
You should always have some skepticism.
A lot of skepticism.
In everything. You know, you should always be asking questions like, what do they stand to gain from saying things like this? And
exactly.
What's their angle? You know, I think that's just a good practice to always have.
What's the angle?
Yeah, there's always an angle.
There's always an angle.
Yeah, so you got to just try to see through it and, you know, make your own decisions. But at the end of the day, you want to be invested.
Yes, you do want to be invested. You said something actually that was not true. You said basically by investing, the company gets more money. It's actually not true.
Well, their market cap goes up, right?
Yeah, but the company doesn't get any of that money.
Oh, all right.
The
shareholders keep it.
The only way that they get money is maybe they own their own stock, and then if they sell that stock, then they get money.
Okay.
But
the value of their holdings goes up, but they don't necessarily get more money.
Yeah, like when you're buying, a portion doesn't go to the company.
Oh, it's almost even worse. I almost wish the company would get more, so then they could
like reinvest it into the company or something.
Right. Yeah, but instead, just the C-suite can sell it when it goes up really high.
Pretty much,
and just pocket it.
Pretty much. Wow. And or whoever the biggest holdings are.
The more you know. That's why we do this, Mr. Ricci.
Yeah. So that was a big one. Yes, definitely stay invested. Try to pay down your loans as best as you can. Really try to convince yourself that like when you pay that, you're making that return instantly, and that's a very good.
Because you do eventually make it. I mean, you're saving it, you know. But that's a good way to think about it. Is that you're just basically pocketing this money that you have now saved in the future. Because it's the same thing.
I think so. Yeah, I think we're saying the same thing.
It's a good way to think about it. Is instantaneous.
If you have a 31% loan and you pay $1,000, think about it as I think it's just $31, right? All right, everybody, you're learning how I build algorithms to do this. I know it's that'd be like $300.
Even better.
So you
have pocketed now that money.
Yeah. I think of it when I was doing it. I was like, okay, I paid $1,000, 31%. I actually just made $300 by making that payment, or whatever 31% is.
I love it.
That's how we do it.
All right. Well, I think we've covered a lot. We are gonna need more questions next time.
Well, we're going live next time, so make sure to look out on the Twitters, either Hedgeye Twitter or at least Hedgeye. So my Twitter's HEDGEYEAI. EYEAY.
A lot of vowels.
But I'll post when we go live. But we want to go live, so people, or send us your questions. Look out for when we go live. And hopefully we'll have like a little thing going of all you guys asking us questions.
Stream, potentially, yeah.
Exactly.
Like, throw questions at us now. Throw questions at us when we go live.
Look out for us, and we're going to try to do this.
Yeah. So, thanks for the questions this time. And, we'll see you next time when we go live.
In Nevada.